I actually started when I was 14. My dad had a printing company, fairly good sized printing company. We all the kids, I'm the youngest of 6, and we all worked in the business. I worked in bookkeeping. And so my mother was the controller of the company. And so I loved the accounting. It was great. And then I loved law. And so when I went to the University of Utah to do my undergraduate in accounting, one of the very first classes I took, they actually offered 3 different tax classes in undergraduate accounting, which is really unusual for an undergraduate program. And the professor was terrific. Professor Haney was amazing. He was enthusiastic. He could explain it, and I fell in love with it. And then I asked him, I said, okay, so do I want to be a tax lawyer or do I want to be a tax accountant? He goes, well, what do you want to do? I said, well, I want to do tax. He said, well, then be a tax accountant. He was a lawyer. But he said, be a tax accountant because you'll do more tax than you would as a lawyer. I'm going, okay. So I got my master's degree in professional accounting with the emphasis in tax from the University of Texas, which still is the #1 tax program in the country. And then I spent 7 years with Ernst & Young, including 3 years in the National Tax Office during the Ronald Reagan years, before you guys, and long before you guys, I think. And then I spent 4 years as the in-house tax advisor for a Fortune 1000 company here in Arizona. I spent 14 years as an adjunct professor in the Masters of Tax program at Arizona State University, created a course on multi-state income tax and sales tax for them. And then I built CPA firms for about 25 years and launched a network of CPA firms a number of years ago. And recently we launched our franchise. So we are the first CPA-based tax advisory franchise in the U.S. And we're very excited. We're very excited about serving entrepreneurs. That's who we're excited about.
I think most of our listeners respect the need to know more information about taxes. They get excited about that, but I don't think there's, the general population is something they focus a lot of time on. It comes around tax time, maybe they hop on TurboTax, maybe they go down to their local, chain kind of place to do their taxes. What's your sales pitch for people and why they should care more about their taxes?
Well, it's your #1 biggest expense, right? So if you care about your #1 big expense, I mean, the question is not how much money you make. The question is how much money do you keep? And if you care about that, and if you start beginning to understand, as I wrote in Tax Free Wealth, the tax law is a series of incentives, and it's just looking at, okay, what does the government want me to do? Am I willing to do it? And if I am, then I can reduce my taxes. If I'm not willing to do that, that's fine, right? I mean, if you want to work, if you want to do business when you're on vacation, you can take the write-off if you do it right. If you don't want to do any business on vacation, you're not going to take the deduction. And there's nothing wrong with either side of that. But what's wrong is when people don't know enough to have a choice. And that's my mission, is to actually give people a choice. So the people ask all the time, okay, I got this morning. So I was doing my podcast, the WealthAbility Show, and the guest said, you ask a simple question like, is something deductible? And that's a complex answer. And I said, the problem is you're asking the wrong question. The better question is, how do I make this deductible? Not, is it deductible? Because asking whether something's deductible, I'm sorry, it's a stupid question. Okay. It doesn't get any kind of answer because it all depends, right? But how do I make it deductible? I can tell you that.
All right, crossing out how to make this deductible off my questions list. Just kidding.
No, that's the right question. Whether it's deductible or not, wrong question.
One word that was really interesting to me, and I think it was probably very intentional because it's bolded on the cover of your book. People definitely check this out, Tax Free Wealth. This book was like a game changer for me. I remember listening on an audiobook, had to go back and re-listen to a couple chapters that specifically applied to me. But the subtitle is How to Build Massive Wealth by Permanently Lowering Your Taxes. Now, I know a lot of people are thinking, well, how do I lower my tax bill this year? Maybe I can use a strategy like, cost seg. I can do a cost seg study and lower my taxes for this year. Or, maybe I can get a bunch of deductions by donating to this charity this year. What do you mean by permanently? I'm guessing that was a very intentional word in there, and I'd love if you could expand on that in any way you see fit.
So a number of years ago, I attended a marketing conference for CPAs, which is kind of an oxymoron by itself. But it was in Manhattan, downtown Manhattan, and I thought it'd be interesting to just ask people, because this was before I'd written the book, and I was trying to do a little kind of anecdotal research. And I asked them, I said, how much of your tax planning that you do is deferral, meaning postponing taxes to a later year, like pension plans, IRAs, 401ks? And the answer came back pretty consistently, 100%. Very consistently. And I'm going, so the tax law is about 6,000 pages, give or take, in very, very, very small print. It'll put you to sleep if you read it for more than about 30 seconds. 400 of those pages talk about deferring taxes. Now, 99% of the tax law is just a roadmap. It's an explanation of how to reduce your taxes. That's what the tax law is fundamentally. Okay. There's a few pages that give you charts and tables, how much tax to pay, that kind of stuff. But most of it's really just a guide to reducing your taxes. Only 400 of the 6,000 pages is dedicated to postponing your tax liability. The other 5,600 pages is devoted to permanently reducing your taxes. Now, you mentioned cost segregation. I'm not saying don't do a cost segregation. I'm saying do a cost segregation and make it permanent. So most people think, well, if I do a cost segregation, I'm going to have to recapture that. And my question is, why? Why do you have to recapture it? Not necessarily. There's no reason you would have to recapture that. So the only reason you're recapturing it is because you don't understand the rules. You don't understand how to not recapture it. You don't understand how to not pay tax when you sell real estate. So my point is, when we change the question, this goes to that first question, not is it deductible, how to make it deductible. Not is it temporary, or is it permanent, but how do I make it permanent? So certain things are obviously permanent. If I take an expense that I have and I make it deductible, that's permanent. I never have to pay that back, right? So if I've got a house, and I claim a home office deduction, right? Then the deduction for the utilities and the internet and that kind of stuff, I'm never going to have to pay that back. Whereas if I put my money into an IRA, 401k, pension plan, I am going to have to pay that. Eventually, I may pay it at a slightly lower tax rate overall, but I am going to have to pay it back. If I don't understand how to deal with cost segregations, then eventually I'm going to have to pay that back. If I don't understand how to make it permanent, then I'm going to pay it back. Well, why do the temporary stuff if I can do permanent stuff? Because if I do permanent stuff, it's my money forever. And I'd rather just have it be my money forever.
And I know that, your focus is helping entrepreneurs, and that's where we'll spend a lot of this conversation. But just to kind of knock this out early, for those people who are out there just kind of working a normal W-2 job, who just own their singular home, maybe they're not a real estate investor, is there a reason for those people to also be, really interested in this topic, dig deeper, maybe look to working with professionals, or is that scenario so simple that there really isn't enough interest there, and your kind of standard free tax software is probably doing a fair job?
So my second book, The Win-Win Wealth Strategy, in that book, I go through 7 different investments the government will pay you to make. Of those 7, 2 of them will apply to employees. So 2 out of 7, so 40%. Still applies to employees. The rest of them, you've got to be an investor or an entrepreneur or a combination of the two. The tax law definitely favors entrepreneurs and investors for sure. But there are things that they can do. And some of them for sure ought to be at a minimum maxing out their 401k. I mean, if they're going to, take the easy route and invest in ETFs and mutual funds and a 401k, then they ought to max it out. Because it actually is, it's far better than not doing it.
So one thing that I would think applies to everyone, whether you're a W-2 worker or an entrepreneur, is choosing which buckets to hold your investments in. So, for example, you might hold high-risk stocks in a certain bucket, like in a Roth IRA or 401k or brokerage account. You might hold more passive, just total stock market index funds in another bucket. What's your bucketing strategy, and what's the most optimal way, tax-wise, to set those allocations?
Well, it's interesting because you actually talked about a couple of different things there. You talked about asset protection strategy and tax strategy, and we actually think there's 4 pillars to building wealth, and certainly tax strategy is one. Wealth strategy is one, because what you do with your money has a major impact on your taxes, not just how you earn your money. Asset protection strategy, and then your legacy strategy, right? So those all have an impact on your wealth, and they all have an impact actually not just on your wealth when you die, but actually on your wealth while you're building it. And they also have an impact on how much tax you pay. So, I think that what people have to look at is, yes, I first have to look at how do I make my money. So how I make my money is question number one. So if I make my money for a business, for example, I have different risk and I have different tax implications than if I might make my money in real estate. If I make money in real estate investing, that's going to have different tax implications, because right now we still don't have Social Security tax on real estate rental. And because of that, then I don't need to use an S corporation, for example. In fact, I don't want to use a corporation for real estate. I pretty much never want to use a corporation for real estate unless it's my business. Unless I'm in the development business, or I'm in the fix and flip business, something like that. That's different. That's a business. That's not real estate investing. And so you do have to look at that. And then you look at risky versus non-risky assets for sure. Now that's an asset protection question. I'm not an attorney. So I won't give advice there. I am pretty well educated in it. And I do believe that when you do a tax strategy, you ought to do your asset protection strategy, and that your accountant who does your tax strategy should be speaking with your attorney who does your asset protection strategy, because they go together so closely. So I might recommend, for example, a partnership from a tax standpoint for real estate. The attorney will say, okay, let's do that partnership. Let's do it as an LLC, because there's asset protection LLC. From a tax standpoint, an LLC does nothing for me. From a tax standpoint, from an asset protection standpoint, it does. So you really do have to combine the two. And those non-risky assets, that's a whole different animal. Non-risky assets, some of those are just in your family trust.
Early on in the episode, you listed off a lot of kind of, education and training that you've been through, and over time, like, tax laws change. What are some of the trends that we're seeing? Like, it's because we're always trying to make decisions now based on what we think is going to happen in the future, especially with a lot of this, like, as you mentioned, the kind of deferral type tax decisions. Is there a general trend that we're seeing, or is it just ebbs and flows, kind of pulls and pushes?
So when I was in Washington, D.C. in the 80s, the Reagan tax law, 86 Act, severely reduced the tax rates. We got down to 2 tax rates. They were very low tax rates, broadened the tax base, lowest tax rates we have ever had before or since, since the 1940s, right? When Roosevelt raised them to obnoxious levels, but Reagan broadened the base and lowered the tax rates. Since then, you've seen a steady increase in tax rates. I think right now we're the lowest we're going to be. I don't think we're going to get lower. As you know, there's a big call in certain political circles to tax the rich. Okay, well, tax the rich just means tax everybody, just more, right? Just don't tax me, but tax everybody else and tax them more. And that is definitely a trend. And I think particularly as you see, there does continue to be a gap between the richest and the poorest. And even though the poorest seem to be doing better, they're still not doing as well compared to the rich, because the rich are doing so much better. And so I think that there's still this idea that, wait a minute, we need to put more of a burden on the rich because they are getting too much money And that's why our housing prices are going up and everything else is going up. So I do think that we're going to see continual, it's going to be a trend towards increasing taxes. I mean, even next year when we're going to have major tax law changes because of the 2017 Act expires next year. Even next year, I don't think we're going to see any reduction next year. If we're fortunate, we won't see an increase, but we're not. I just don't see a reduction coming. I think it's going to continue to increase.
So with you dropping that on us, we got to dig into it. What is going to change next year? What are some of those things from the 2017 Tax Act that are dropping off?
So everything drops off except for the corporate tax rate. Everything. So your 20% deduction for a small business drops off. Your bonus depreciation goes down to 40% next year, then goes down 20% in 2026, and then it drops off. You're going to see the estate tax. Right now, we've got a $13 million exclusion. It'll drop back to $6 million. So that is automatic. So if nothing's done, basically everything goes back to pre-2018. So that means that the top tax rate becomes 39.6%, not 37%. That means, by the way, the lower tax rates actually came down more than the higher tax rates in 2017. It's just a bigger number because it's more money. But the lower tax rates actually dropped more. So that would be a major tax increase. Now, you have President Biden says, well, we're not going to increase taxes for anybody who makes more than $400,000, which, within 5 years of inflation is going to be everybody, right? But that's kind of his pledge. And so what that means is that those people that are under 400,000, and by the way, married, filing jointly, that's not individuals. That's the combined income, the household income. They're probably not going to see a tax increase no matter what. Okay. So you're under that $400,000 threshold. You're probably not going to see a tax increase. If you're over that, it depends on who controls the House, the Senate, the presidency. All of that depends on the politics of it. The Republicans want to really continue the 2017 Act, which would basically reduce taxes from where they were in 2017 before the Act by about $2 trillion, whereas the Democrats want to increase taxes by $5 trillion. So there's a $7 trillion gap between Republicans controlling and the Democrats controlling.
As we've been talking through the taxes, and I know, like you've mentioned, your focus is more on like entrepreneurs, business owners, because there's more for them to control. There's more like things for them to take advantage of than a typical W-2 employee. If someone is sitting there and maybe they're looking to go into becoming an entrepreneur, to starting a business, are there certain types of business that are more, kind of low-hanging fruit for this sort of thing, where it's easier to set up some great tax strategies? Are there certain types of businesses that really play into the tax strategy?
Not really. The nice thing about the tax law is it's so favorable to starting a business that the government will actually pay you the cost to start it up. So the tax reductions are greater than the cost of starting a business, particularly if you're in something like doing something online, particularly but you have to know the rules, right? So, I hear people all the time saying they were told, don't take a home office deduction because it raises a red flag with the IRS. I'm going, it raised a red flag, get this, prior to 1997. So you wonder, you talk about there's a lot of education to keep up on. Well, unfortunately, a lot of tax preparers are not keeping up on that education because they're still talking about things that were pre-1997. Last I checked, we're in 2024. So that's kind of a major challenge that people run into. And, but generally you can start any business. Personally, I'm a huge fan of starting businesses. I think it's a great idea. You want to reduce your taxes, the best way to reduce your taxes. I would say that, certainly if you buy a business, you don't get as big of a tax advantage right off the bat than if you start it from scratch. A franchise, you've got a little better advantage than if you bought a bigger business because you don't have to amortize as much. But all business is good. I mean, that's just the general rule. And it doesn't matter even what country you're in. All business is good from a tax standpoint.
So when we're talking a business, what constitutes a business? Someone who is flipping furniture, or they start an eBay store, they're just selling stuff out of their garage. Is that a business, and can they take deductions on that, or what's the lowest barrier to entry for this stuff?
Profit motive. Profit motive is the threshold. It doesn't have to be a big profit. It just needs to be a profit motive. So if the opposite of a business is a hobby. So the IRS says if you have a profit 3 out of 5 years, you're a business. If you don't have a profit 3 out of 5 years, you may or may not be a business. Now, horses are different. That's 2 out of 7 because they know that people who have horses don't make profit much more than 2 out of 7 years. I've heard people say, well, I'm going to go buy a horse because I want the tax write-off. I'm going, that's not going to do it for you. It's still a hobby. Hobbies do not get tax benefits. Now, they still get some, just so you know. A hobby, you get to deduct up to your income. So you'd have non-taxable income. So even in a hobby, you get some benefit. You just don't get offset other income. You can't create a loss with a hobby. But you know, any kind of business, you can, as long as you have a profit motive and can show the profit motive.
Well, when you talked about how that, having a home office doesn't necessarily raise a red flag with the IRS, and maybe that's a misconception, what are some things that people should look out for? Like, hey, that will raise a red flag, or maybe some other misconceptions that people are scared to maybe file for or try to get, but are actually not a red flag.
So a lot of that depends on your tax preparer. We find that we can eliminate most red flags when we prepare tax returns. Any of our franchisees, we've taught them, here's how you eliminate red flags. Now, a home office deduction could be a red flag, but the only way it's a red flag is if you have a Schedule C, but a Schedule C is a bigger red flag than a home office deduction. So you've just compounded it by using a Schedule C. And you'll have an accountant will say, well, don't take a home office deduction, but you know what? Do a Schedule C because it's easier. But Schedule C is a way bigger red flag than a home office deduction. And it's so expensive to have a Schedule C. Why would you do that from a tax standpoint? It's the worst thing you can do. Or a general partnership. It's the only thing that's worse than a sole proprietorship Schedule C. And it's so easy. Just have an LLC and tax it as an S corporation. It's a really easy fix. And you can save thousands and thousands of dollars and you don't have red flags anymore. So really a lot of it is, what kind of a strategy have you done with your tax advisor, and what's your tax preparer doing to eliminate those red flags? Let me give you a simple example. The IRS hates the word seminar. You go to a seminar, they go, that's personal. That's not deductible. On the other hand, continuing education in your field is fully deductible. So why would you ever call it a seminar? Call it, if it's continuing education, which is the only thing that makes it deductible anyway, call it continuing education. Don't say, well, don't have something in your QuickBooks file that says seminars. That's a dumb idea. Make it continuing education. All of a sudden, you've eliminated a red flag, right? So remember that to have something be deductible, to answer the question that I was brought up at the beginning is how do you make it deductible? There's really only 4 tests. And the first is you have to have a business purpose. The second is it has to be ordinary, meaning typical in your business, both in amount and frequency. And then the third one is it has to be necessary, meaning there's a profit motive. And the fourth one, you have to document it. Okay, but just do those things. Do those things and then make sure your tax preparer is calling it the right thing or your bookkeeper is calling it the right thing. I think another mistake people make is they either do their own bookkeeping or they have a family member do their bookkeeping, and they really ought to be hiring an outside bookkeeper. It can be hard to find good outside bookkeepers. We actually make sure we have relationships with outside bookkeepers so that we can refer people to them. But you really need good bookkeeping to begin with, because bad information produces bad results.
So going back to my example from earlier, I want to give people some real tangible examples. Let's use the Gary V, go to yard sales and flip stuff style of entrepreneurship. Maybe you're driving around, you go and get some stuff and you see that has value, then you go home, you list it on eBay. Let's just, very basic scenario, but what types of things, now that you have a profit motive, you have a business, can you start deducting? Like, can you deduct your internet? Can you do the mileage?
You've got your home office. Right? Now, by the way, so a home office doesn't just create a home office deduction. It increases your automobile deduction because you no longer have a commute. Your commute is from your kitchen to your home office. That is your commute. And when you come home at night, you go to your home office, do your admin work, and then you go back to your kitchen. Don't stop at the kitchen when you get home at night. I mean, it's these little simple, they're tricks, right? But they're little simple things that if you get audited, you can say, well, here's how I function every day. You're welcome to watch me. Come see me. Okay. This is how I do things. And you'll see this is what I do. Well, by doing that now, as I make that first trip to the yard sale, right? If I could do that trip to the yard sale and don't take a home office deduction, that first drive to that first yard sale is a non-deductible commute. Whereas if I have a home office, it's all deductible. So you basically double your automobile expense deduction simply by having a home office. So this is why, you have to understand that the tax law is not a linear document. It's a very nonlinear thing. It was written by lawyers, not accountants. And so you've really got to understand that different sections interact with other sections, and you kind of have to bring them all together, which is, kind of why you need a good tax advisor. But going back to your example, your automobile, all of your expenses with regard to your automobile. By the way, leasing, most automobiles, way better tax deduction than buying. Okay, little known fact. It's way better now to lease than it is to buy. And by the way, the interest rates are about the same. So why would you ever buy a car anymore? Unless you're buying a truck. And if you're buying a truck, then you get a bigger deduction if you buy it. Okay, so you're going to get all those expenses. You're going to get all your home office, which includes your internet, your maintenance, your house cleaner. You're going to get a portion of your utilities. You're going to actually get a portion of the cost of the house and depreciation. So the interest expense that might not otherwise be deductible, because it's not all deductible now. Taxes that might not otherwise be deductible because they're not otherwise always deductible now. And so you're getting a lot of these deductions. On top of that, your actual expenses. So whatever the cost is on eBay, the computer that you use, as long as you dedicate it. Now you have to dedicate it to the business, right? But the computer you use for eBay, absolutely. If you use the internet only for eBay, which nobody does, so you kind of typically have to allocate that between the business use and typically that's done by your home office, right? That percentage. Which, by the way, I'll give you a little trick there. The IRS says you have three choices on how to determine what percentage of your home qualifies your home office. One of them is they're simplified, which is terrible. You get nothing, right? But it's simple. Another one that most people use is square footage, which is a terrible idea because your home office is usually the smallest room in your house. Or you can actually do percentage of rooms. So if I have 10 rooms in my house and one room is my home office, then I get 1/10. Whereas if I took square footage, it might be 1/20. So, and the IRS is very clear, even in their instructions, you can look it up on irs.org, that as long as the rooms are fairly similar in size, you can take number of rooms as opposed to size of room instead of square footage. And of course, you wouldn't include common area like hallways and bathrooms and so forth. They're not rooms. So you're really getting a lot more home office that way. So there are little things you can do. The more important thing is that you actually have, I think, a you're strategic about it, and you're actually strategic not just about how you make your money, but actually what you do with your money.
So as we go through all this, I'm just thinking about like what you mentioned, like keeping records of it, like the bookkeeping. What kind of advice do you have for people out there who, maybe you're spitting off all these things and it just starts to sound overwhelming, like all the different expenses and percentages and allocations that they need to come up with? What are some tips and tricks to, get your hands around all this data?
Well, there's some simple things you can do. For example, you wanted to look at receipts, just scan them and keep them in a scan file. Right, that's easy. If you're still doing old school and keeping receipts by hand, then just get manila folders and put them in manila folders. Right. I prefer the scan because if you get the original, eventually it will disappear. Right, it goes away, and that doesn't do you much good when the IRS comes knocking. And they will. By the way, that's another trend, is that the IRS is going to come knocking a lot more often, probably 4 or 5 times as often as they have in the past. Kind of the past 20 years. Within the next 3 years, it'll be 5 times. We'll have 5 times the IRS audits that we have right now. So that's a big deal. But keeping that documentation, in real estate, it's location, and in tax deductions, it's documentation. I always tell people that if you pretend to document, you get a pretend deduction. So the IRS will always ask for your documentation. First thing they're going to ask for. And if you don't have it, they don't care if you are legit or not.
Something you mentioned probably 20 minutes ago at this point, you were saying that this is probably the lowest tax period we'll ever be in. With that being said, do you recommend, if you have the choice to pay taxes now or taxes later, like the Roth versus traditional debate, are you just team pay your taxes now in most circumstances?
No, I'm team run the numbers.
Fair enough.
I'm always team run the numbers, because I will tell you, sometimes it is better to pay taxes now. I'll give you a simple example, and sometimes it's better to take a deduction later. So these days, lots of Ponzi schemes, right? I mean, just like every other day, you read about a Ponzi scheme. Well, Ponzi schemes, you can actually deduct. If it's classified as a Ponzi scheme, you can deduct 95% of it as soon as it's classified as a Ponzi scheme. You don't have to wait until you find out if there's going to be any money to come back to you. It's an itemized deduction. Itemized deductions don't carry forward if you have more itemized deductions than you have income. And a Ponzi scheme loss can be a big loss, because that's an investment you made. So it could be hundreds of thousands of dollars. Some cases, millions of dollars. You might lose that deduction because you took it now. If you waited, it's an investment loss and it's a capital loss. Well, capital losses carry forward forever. So until you have capital gains. And so you may be better off. You think, well, I want to take an ordinary deduction now instead of a capital loss, which I can only use against capital gains. But if I take an ordinary loss now, I might lose it. So that's why you still have to run the numbers. It's like people will come to me and say, well, should I do a 1031 exchange in real estate or should I sell it outright? I'm going, well, what are you going to do with your money? Well, I'm going to keep it in real estate. Well, run the numbers, because with bonus depreciation, even at 60%, frequently you're better off recognizing the gain and taking the bonus depreciation on the new property. And the reason is because bonus depreciation is an ordinary loss and comes off your ordinary income. Whereas the gain, when you sell the property, should be capital gain. Well, it's taxed at half the rate. Capital gains are basically half the rate of ordinary income. So why would you use, if you do a 1031, all you're doing is escaping capital gain. But if you do, if you do a cost segregation bonus depreciation on your new property, you're getting an ordinary deduction that could maybe offset your wages, could offset your business income. It doesn't just have to offset the capital gain from the sale of the property. So again, you always have to run the numbers. That's why, your tax advisor needs to be a really good accountant to be able to run numbers.
I could imagine another situation where, that kind of traditional versus Roth debate, even if tax rates continue to increase, could be a little nuances for like a lot of our listeners who are trying to retire early. Like maybe they're making the most money now by far than they will make the rest of their life because they plan on pulling the plug, at a very young age.
Mhm.
Do you have any kind of specific insights or considerations for that specific audience, like an audience who's looking to retire,
Yes,
maybe in their 30s, 40s?
As a matter of fact, Justin, I ran the numbers in chapter 8 of the Win-Win Wealth Strategy. And I actually ran the numbers for doing a regular versus a Roth. And most of the time, actually, you're probably better off with not doing a Roth. You're probably better off doing the regular IRA. And the reason is just what you're saying. I'm a high income earner right now. I'm making $600,000, $700,000, $800,000, whatever. I'm in that highest tax rate right now. When I retire, even if I pull the same number out, so let's say I make $400,000 a year now, and when I retire, I'm going to pull out $400,000 a year. Well, when I take the deduction for my IRA or 401k or pension plan, then it comes up the highest rates. So I might get a deduction at 37%, but pick up tax anywhere from 0 to 37%. So I end up with, because tax brackets are a very important part of our structure. We have a graduated, tax system. Well, it's graduated when you retire too. So you get all of those lower tax rates, which is why, and honestly, I was a Roth guy all the way. Yeah, totally all the way until I wrote Win-Win Wealth Strategy. And I'm going, wait a minute. The numbers actually do play out that if you make the exact same amount of money when you retire as you did before you retired, you're probably better off actually putting the money into that deferral account because of those tax brackets. Because those tax brackets do produce a permanent effect when you do start taking it out. Now, that said, there are some times when I think a Roth and converting to Roth makes total sense. And some of it's going to be, just like you said, Justin, it's going to be how long are we talking about here, right? So again, you got to run the numbers.
So when it comes to your 4 pillars of wealth, the one where I am a complete novice, and it's probably because I'm younger, I haven't spent enough time studying this stuff, is legacy. And when I just start looking at trusts and estates and all these revocable, irrevocable, I'm like, oh my God, there's so much terminology, so much jargon. Could you just talk about a very high level what a good estate plan, what a good legacy strategy looks like?
Yeah, first thing is everybody should have a will, especially if you have kids, because you're going to put your guardian for your kids in your will. That's the most important part of a will. I think everybody should have a living trust. That would be a revocable trust. That's the technical term for it. But you call it a living trust or a family trust, whatever you call it. They're cheap. And you can get all of this done, by the way, for like under $3,000. So it's while that's some money, it's, when you think of what the benefit is, there's no tax benefit to it. There's no asset protection benefit to it. The benefit is that once you have assets in a trust, you never have to go through probate. If you die suddenly, the people who survive you, your spouse, your kids, they don't have to worry about anything. It's done for them. And it's just that peace of mind. That's why I think the legacy part is so important, even if you do just the basics, which is a living trust and a will. Those are the basics, right? Get the basics done. Get your medical power of attorney done. Get, just these really basic stuff. That is just going to make life easier for whoever survives you. Then as you start building wealth, and I know you've got a lot of people who are close to, they're looking at some kind of a liquidation of their business. They're selling their business. They're like you guys. They've done really well, and they've got a liquidation, capital event coming up, and so you're going to have some significant assets, and you want to build significant assets. I had a friend once he called the estate tax the stupid tax. He says, because you have to be stupid to be paying it. And I'm going, I thought that was a little harsh. But the reality is it's pretty easy to get out of the estate tax if you plan. If you don't plan, it's a lot of money. It's 40%. By the way, the Build Back Better plan that Biden proposed in 2021, the estate tax, if you took all the provisions into account, was 92%. Wow. It was 92%. So if you built this business worth $100 million, your kids would get, or your spouse, not your spouse, but your kids would get $8 million out of that $100 million. The rest would go to the government. That is on the table for the next Congress. So depending on, again, who's in the White House, but just remember that if you do have significant assets, I'd say more than $5 million, then you do need to do estate tax planning, not just your standard trust plan. The other thing to remember, go back to the asset protection. The best asset protection in the world is a trust that you set up for somebody else, like your children. Okay, it can even have your spouse can even be a partial beneficiary. But those are called spousal trusts. But you set up something for your kids, no creditor is going to be able to touch those assets if you do it right. No creditor can touch them, ever. So I have trust for my kids. They're grown. I could distribute the assets, but why do that and put them at risk for the creditors? There's no need to. We can distribute as we want, but that's great asset protection. So I think that the legacy is something that very few people do. I do it twice a month with our clients, of all of our franchisees. I do a webinar, and the actually topic last night was legacy, and we were talking about non-tax issues. And I've got to tell you, it was really interesting. We did a poll at the beginning. Only 60%. And these are clients, right? So these are people who actually have some pretty serious knowledge. Only 60% had actually done a trust and a will. I'm going, okay, so that's a weakness that we need to change, because you need to do a will and a trust. That, to me, that is non-negotiable.
Well, this is an extremely nuanced topic, and there's a lot of ins and outs. And like you mentioned before, like maybe not everyone's out there doing their continuous education, keeping up to speed. For people who are out there, maybe looking to work with a professional, what are some tips that you have for them to make sure that they're aligned with someone knowledgeable? Like, what are the right questions to be asking to make sure that, they're partnering up with somebody who's worth it?
Well, good news is Chapter 23 of Tax Free Wealth is how to find a good tax advisor. So got a whole chapter on it. Pretty easy. $22 on Amazon. So that's kind of a cheap and easy way to go. I actually think it's the questions that the tax advisor asks you are way more important than anything you ask them. If you have to ask the question, you've got the wrong tax advisor.
Fair enough.
I truly believe that. If you have to ask the question, you've got the wrong tax advisor. Now, there's going to be times you're going to be asking questions, but like we talk to our clients every month. We're the ones who schedule the calls. They don't schedule calls. We schedule the calls, right? We make sure that we are in charge of their tax situation. They don't have to be in charge of it. We're in charge. Now, there are things they have to do because I can't change your tax. I can only tell you the things that you need to do to change your tax. But I do think that having somebody that actually really takes control of that is the best way to do it. I will tell you, there is an easy button. You go to wealthability.com and you engage one of our franchisees. We've already done all the vetting. We've done all the training. So they live by tax-free wealth and win-win wealth. So these are people that they are fully engaged. So that would be the easy button. Otherwise, I would go to Chapter 23 of Tax Free Wealth.
All right. Well, check out WealthAbility. Check out Tax Free Wealth. Where do you want to send people, Tom? I know we're going to have a lot of questions, a lot of people really interested in the topics we talked about on this episode. But as we bring this thing to a close, where do you want to point our audience?
Well, so go to wealthability.com. If you have questions, team at wealthability.com. But certainly go to wealthability.com. There's tons of information. Tax-free wealth, my podcast, The Wealthability Show. We're all over, I've got YouTube channel we're all over the internet. So, check us out on social media. I like YouTube because we can do a little deeper dive. And tax is a pretty complex subject that we try our best to make simple. And so I would particularly focus on the YouTube channel and the WealthAbility Show podcast, which is a more general economic podcast rather than just a money podcast than it is just a tax podcast. We have great guests on that show as well. So I do want to say thank you. I love what you guys are doing. I absolutely, everybody who does solid financial education deserves a pat on the back. So really appreciate what you're doing.
Well, thank you so much, Tom, for giving us some time. And like you said, it's not so much about how much you make, it's about how much you keep. And so hopefully this episode will help listeners keep as much as possible.